There's a question that haunts the world of finance, a puzzle that seems to defy simple explanation. How did a man from Omaha, Nebraska, starting with a struggling textile mill, build an empire worth nearly $1 trillion? How did Berkshire Hathaway, a name that once meant shirt linings, become the single most respected financial institution on the planet? The common answers you hear are vague. They talk about value investing, long-term holding, and buying wonderful businesses at a fair price. And while all of those things are true, they are profoundly incomplete. They are like describing a rocket ship by talking about its paint job and the shape of its fins, while completely ignoring the colossal engine hidden inside its fuselage. The truth, the real secret, the foundational pillar upon which the entire Berkshire Hathaway empire was constructed, is something far more specific, something the average investor considers hopelessly boring and therefore tragically ignores. That secret is the business of insurance. And more specifically, it is a single, magical concept that flows from the heart of the insurance industry, a concept that Warren Buffett understood better than anyone else on earth. It's a concept called float. Understanding this one idea will not just change the way you look at a handful of companies. It will fundamentally alter your entire framework for evaluating businesses, for understanding capital, and for appreciating the deep underlying mechanics of wealth creation. It is the hidden engine, the financial superpower that allowed Buffett to transform a small pool of capital into an ever-expanding ocean. What we are about to embark on is a deep dive into this engine. We will dismantle it piece by piece, not with confusing jargon, but through the stories, the psychology, and the hard numbers that define it. You will learn to see what Buffett sees, to value what the market misunderstands, and to recognize one of the most powerful compounding machines ever devised. This is the story of float, the story of how being paid to hold other people's money became the most powerful business model in the world. To truly grasp the revolutionary power of this idea, we must go back in time, not to the gleaming skyscrapers of modern finance, but to the dusty, unassuming streets of Omaha in the mid-1960s. This is where our first pillar stands, the discovery of float, the foundational acquisition that would change the course of financial history. This story begins not with a grand strategic plan, but with a chance encounter and a moment of pure intellectual insight. Warren Buffett at this point was a highly successful but relatively small-time fund manager. He ran the Buffett Partnership, and his primary business was stock picking, finding undervalued securities in the public markets. His base of operations, however, was Berkshire Hathaway, a failing textile manufacturer in New Bedford, Massachusetts, which he had taken control of in 1965. The textile business was, in his own words, a nightmare. It was a business that consumed capital. Every dollar of profit had to be plowed back into new looms, new equipment, just to stay competitive in a low-margin, dying industry. It was a financial black hole. For a man obsessed with the power of compounding capital, it was the absolute antithesis of what he wanted. He needed a business that didn't consume capital, but one that generated it. He founded in 1967, and it wasn't a textile mill. It was a small, obscure property and casualty insurance company in Omaha called National Indemnity Corporation, along with its sister company, National Fire and Marine. The company was run by a man named Jack Ringwalt, a brilliant but eccentric insurance man who was, frankly, tired. He had built a solid, profitable business from the ground up, but he was ready to sell. He wanted out, and he wanted to sell to someone who would take care of his creation. Buffett knew of Ringwalt and the quality of his operation. One day, he simply called him up and asked to meet. The negotiation that followed is the stuff of legend. It wasn't a drawn-out affair with teams of lawyers and investment bankers. It was two men from Omaha, sitting in a room, talking numbers. Buffett examined the books. He saw a well-run insurance business, one that consistently took in more in premiums than it paid out in claims and expenses. But he saw something else, something much more important. He saw the balance sheet, and on that balance sheet was a liability, a line item, that other people saw as a risk. a future obligation. This liability was the collected insurance premiums, the money paid by policyholders for coverage they had not yet used. This pool of cash, which National Indemnity held but did not own, was called the float. At that time, it was about $17 million. Buffett asked Ringwalt his price. Ringwalt, wanting to get the whole thing over with, scribbled a number on a piece of paper. The price was $8.6 million. For $8.6 million, Buffett could buy the entire company, a company that was not only profitable on its own terms, but which also came with a $17 million pool of other people's money that he could then invest for Berkshire's benefit. The insight that struck Buffett in that moment was profound. He was running a textile business that required constant, massive injections of cash just to stay afloat. For every dollar of net worth, the textile business had to tie up even more in inventory and receivables. It was a capital sink. Now, he was looking at a business that did the exact opposite. For a purchase price of $8.6 million, he wasn't just getting the company's net worth, he was gaining control of a $17 million investment portfolio, funded for free by its customers. The transaction was completed with breathtaking speed. There was no extensive due diligence. Buffett knew the quality of Ringwalt's character and the simple, powerful economics of his business. He wrote a check, and just like that, Berkshire Hathaway, the struggling textile mill, was now the owner of a premier insurance operation. This was the pivot point. This was the moment Berkshire ceased to be just a vehicle for stock picking and began its transformation into a capital allocation machine, fueled by the rocket fuel of insurance float. That $8.6 million investment in National Indemnity was the single most important acquisition in Berkshire's history. It was the seed from which the entire empire would grow, the discovery of the hidden engine that would power decades of unprecedented compounding. The psychological principle at play here is a combination of sublime pattern recognition and the deliberate shattering of mental accounting. Buffett wasn't the first person to understand how insurance worked, but he may have been the first to see it not as an asterisk insurance business, but as an asterisk investment business with an insurance operation attached. The pattern he recognized was the inverse of his textile problem. He had experienced firsthand the pain of a capital-intensive business. The mental model was seared into his brain. Growth that requires cash is hard. When he saw National Indemnity, he didn't just see policies and claims. He saw a business where growth produced cash. Customers paid him up front, and he only had to pay out claims later, if at all. The time between receiving the premium and paying the claim created the float. This was a stunningly powerful analogical insight. He drew a parallel between an insurer's float and a bank's deposit base. A bank takes in deposits from customers and invests that money, but a bank has to pay interest on those deposits. A well-run insurance company, one that priced its risks correctly, didn't have to pay interest on its float. In fact, if its underwriting was profitable, it was actually paid to hold the money. This was better than a bank. It was better than almost any business imaginable. Most executives and investors suffer from a cognitive bias known as compartmentalization or mental accounting. They put businesses into neat little boxes. This is a manufacturing company. This is a retail company. This is an insurance company. The money and strategies associated with each box tend to stay in that box. Insurance executives of the day thought their job was to write policies, manage claims, and invest the resulting float conservatively in government bonds to make sure they could pay those claims. Their mental framework was limited to the insurance world. Buffett completely rejected this. He saw capital as fungible, a single liquid resource that should be deployed wherever it could earn the highest return, regardless of its source. The float from National Indemnity wasn't insurance money. It was simply capital, and its purpose was not just to back insurance policies, but to buy stocks, to acquire whole businesses, to fuel the growth of the entire Berkshire Hathaway enterprise. He was overriding a deeply ingrained psychological tendency to keep things in their place. This ability to see the underlying financial reality, stripped of its industry-specific labels, allowed him to recognize a financial superpower where others saw only a boring, complicated utility. While everyone else was focused on the stated purpose of the business providing insurance, Buffett was focused on its byproduct, a permanent, growing, and free pool of investable capital. So how can we translate this monumental insight into a practical blueprint, a mental model that we can apply to our own financial lives and investment decisions? We can call it the capital generation test. It's a simple yet profound framework for analyzing any business or even your own personal finances. Step 1 is to analyze the cash conversion cycle. For any business you look at, or even your own career, ask a fundamental question: when does the cash come in and when does it go out? A traditional manufacturing business buys raw materials, cash out, pays workers to turn them into products, cash out, and then sells the product on credit to a customer, waiting 30, 60, or 90 days to get paid, cash in. This is a negative cash cycle. The business is constantly funding its operations and waiting to be reimbursed. Growth is painful because it requires more and more cash to be tied up in this cycle. Step 2 is to explicitly ask, does this business consume cash to grow, or does it generate cash ahead of costs? This is the Buffett pivot question. A business that generates cash ahead of costs has a tailwind. A business that consumes cash to grow has a headwind. Step 3 is to actively hunt for sources of negative working capital or float in any industry. Buffett found the ultimate source in insurance, but smaller versions exist everywhere. Think of a magazine subscription business. Customers pay for a full year upfront, but the magazine only has to pay for printing and postage month by month. That subscription money is float. Think of Amazon. When you buy a product, they get your cash instantly, but they may not pay their supplier for that product for 30 or 60 days. The difference is their float. Gift cards are a form of float for retailers. Customer deposits are a form of float for contractors. Your goal, as an analyst or entrepreneur, is to identify these structures because they are sources of free financing. Step 4 is the most crucial. Frame these pools of capital correctly. Do not see them as just an operational quirk. See them as what they are: small-scale floats, interest-free loans from your customers or suppliers that can be reinvested to fuel growth. By applying the capital generation test, you stop looking at just the income statement, revenue and profit, and start looking at the deep structure of a company's balance sheet and cash flow. You begin to think like a capital allocator, not just a manager or an investor. You start to see the hidden engines, or lack thereof, in every single business you encounter. To truly appreciate the genius of this discovery, we must dedicate some time to its antithesis, the path of the 99%. What do most people, most investors, and most CEOs do? They do the exact opposite. They are obsessed with metrics that sound good but miss the underlying economic reality. The first mistake is a fixation on revenue growth and reported earnings above all else. A company can grow its revenue by 20% a year, but if every dollar of that growth requires $2 of new capital investment in factories and inventory, the owners aren't getting richer, they're getting poorer. They are on a treadmill, running faster and faster just to stay in the same place. The 99% celebrate the company that announces a huge new factory, seeing it as a sign of strength. The Buffett-oriented thinker asks, what is the return on the capital that factory will require? And could that capital have been deployed better elsewhere? The second common mistake is a fundamental misunderstanding of the balance sheet. Most people see debt as bad and liabilities as risks, and they often are, but they fail to differentiate. They see the unearned premiums on an insurer's balance sheet and mentally file it under money we owe people. They see a risk, a negative. They completely fail to see the corresponding asset on the other side of the ledger, the massive portfolio of stocks and bonds that was purchased with that liability. They see the potential cost but miss the immediate and tangible benefit. They are, in essence, reading only one side of the financial story. They fail to understand that in the right hands, certain kinds of liabilities aren't risks at all. They are raw material for creating immense value. This is why the market so frequently misprices insurance companies. It doesn't have the right framework. It values them like a boring industrial company, looking at book value and earnings, completely missing the multi-billion-dollar investment engine humming away, hidden in plain sight on the liability side of the balance sheet. The path of the 99% is to look at the surface, to accept the conventional labels, and to use the standard, often flawed metrics. The path of financial insight is to look deeper, to question the labels, and to follow the cash. Let's ground this in the hard numbers of that first, critical transaction. When Buffett paid $8.6 million for National Indemnity in 1967, what did he actually get? The company had a net worth, or book value, of about $6.7 million. So on the surface, he paid a premium over book value, something a simplistic value investor might scoff at. But the real prize was the float. At the time, National Indemnity held about $17.3 million in float. This was money that belonged to policyholders, destined to pay future claims, but in the meantime, it was available for Berkshire to invest. So let's look at the direct financial connection. Buffett spent $8.6 million of his partnership's capital. In exchange, he received control of a business with $6.7 million in net worth, plus an investment portfolio of $17.3 million. The total investable capital he now directed from this single transaction was over $24 million. He had leveraged his $8.6 million almost 3-to-1, without borrowing a single penny in the traditional sense. His cost for this leverage was zero. In fact, because Jack Ringwalt had run the business with such discipline, the underwriting was profitable. National Indemnity was actually being paid a small amount each year for the privilege of holding this $17 million float. This transaction single-handedly transformed the financial structure of Berkshire Hathaway. Before 1967, Berkshire was a capital-starved textile mill. After 1967, it was a capital-generating machine. The float from National Indemnity became the seed corn. It was used to buy more stocks for Berkshire's portfolio. It was used to buy other insurance companies, growing the float even more. And, most importantly, it was used to buy whole companies in completely different industries. The acquisition of National Indemnity wasn't just buying a company, it was buying a private money printer. It was the discovery of an economic anomaly, and Warren Buffett would spend the next 50 years building an empire on top of it. The initial discovery of float was a moment of genius, but to build an empire one must move from a flash of insight to a systematic understanding of the mechanics. This brings us to our second pillar, the economics of float, zero-cost capital. What exactly is this force that Buffett harnessed? How is it created? What makes it valuable? And most importantly, what separates good float from bad? Float, in its simplest terms, arises because insurance companies collect premiums up front and pay claims later. In between those two events, the collection and the potential payment, the insurer holds the money. This pool of money is the float. It's a liability on the balance sheet, because it represents money that will eventually have to be paid out to cover policyholders' losses. But it functions like an asset, because it can be invested for the insurer's own profit. There are two main sources of this float. The first is unearned premiums. When you pay your 6-month car insurance premium in advance, the insurance company hasn't earned all that money on day one. They earn it day by day over the 6-month period. The portion they haven't yet earned is part of the float. The second and much larger component is loss reserves. These are funds set aside to pay for claims on policies that have already expired. For example, a construction company might be sued for a building flaw years after the project was completed. The insurer has to estimate what that future claim will cost and set aside a reserve. This money might sit on the balance sheet for years, even decades, before the claim is finally settled and paid. The sum of these unearned premiums and loss reserves constitutes the total float. For Berkshire Hathaway today, that number is staggering, well over $160 billion. It is a permanent mountain of capital, provided by others, that Buffett gets to invest. To understand why this is so powerful, we need to compare it to the other two ways a company can raise capital: debt and equity. If a company issues bonds or takes out a bank loan, debt, it must pay interest. That interest is a fixed, explicit cost that acts as a drag on profits. If a company issues new shares of stock, equity, it dilutes the ownership of the existing shareholders, giving them a smaller slice of a bigger pie. Float is a third way, and it is superior to both. If an insurer can run its operations efficiently, the cost of its float can be zero or even less than zero. This is where the single most important metric in the insurance industry comes into play: the combined ratio. The combined ratio is the sum of an insurer's losses and expenses divided by the premiums it collected. A combined ratio of 105 means that for every $100 in premiums the company took in, it paid out $105 in claims and costs. It lost $5 on its core business. In this case, its float has a cost of 5%. It's like borrowing money at a 5% interest rate. This is not a good business. But a combined ratio of 98 means that for every $100 in premiums, it paid out only $98. It made a $2 underwriting profit. In this scenario, the company is being paid $2 to hold $100 of other people's money for a year. Its cost of capital is negative 2%. This is the holy grail. A business that can consistently generate float while maintaining a combined ratio under 100 is operating with an almost unfair advantage. It has access to free, or better than free, leverage. This is the economic engine that Buffett perfected. A foundational anecdote that perfectly illustrates the masterful creation of float comes from the world of reinsurance, and specifically from the operations of Ajit Jain, the man Buffett has repeatedly hailed as a genius who has made more money for Berkshire than he has himself. Jain runs Berkshire's super catastrophe, or super cat, reinsurance business. This is the business of insuring other insurance companies against massive, low-probability, high-consequence events. Think of a Category 5 hurricane hitting Miami, a mega-earthquake leveling Los Angeles, or a global pandemic shutting down events worldwide. The potential losses are astronomical, in the tens or even hundreds of billions of dollars. Most insurance companies cannot handle this level of risk on their own, so they buy insurance for their insurance, which is reinsurance. In the years following the September 11th attacks, the market for terrorism reinsurance was in chaos. Companies were terrified to offer it. Ajit Jain and Berkshire Hathaway stepped into this void. They had the capital and the discipline to price risks that no one else would touch. For instance, they might write a policy for a consortium of other insurers that says, "We will pay you $10 billion, but only if your losses from a single terrorist event exceed $20 billion. For taking on this remote but terrifying risk, Berkshire would collect a massive premium upfront, perhaps hundreds of millions of dollars. Now consider the economics of this transaction. Berkshire receives, say, $200 million in cash immediately. This cash becomes part of their float. The probability of having to pay out that $10 billion claim in any given year is extremely low. The money sits in Berkshire's accounts, compounding year after year. Ajit's genius is his ability to rationally calculate the mathematical probability of these terrifying events, completely detached from the emotion and fear that paralyzes other underwriters. He demands a premium that provides him with a statistical expectation of profit. Year after year, Berkshire writes thousands of these unique, massive policies, covering everything from satellite launches to the cancellation of the Olympics. Each time, they collect a premium, a chunk of cash that is added to their ever-growing mountain of float. This isn't the slow, steady accumulation of car insurance premiums. This is the wholesale manufacturing of billions of dollars of long-term, low-cost capital by being willing to think about the unthinkable and price it rationally. This is the economics of float in its most potent and sophisticated form. The underlying psychological principle that makes this possible is the human brain's profound inability to properly assess low-probability events, a bias often called probability neglect. People are very good at thinking about everyday risks, but we are terrible at conceptualizing a 1 in 100 or 1 in 1,000 year event. When a risk is vivid and emotionally resonant, like an earthquake or a terrorist attack, we tend to overestimate its likelihood and are willing to pay a disproportionately high price to eliminate the anxiety it causes. A rational underwriter like Ajit Jain can exploit this gap between perceived risk and actual mathematical risk. He provides peace of mind, an emotional product, and in return receives cold, hard cash that can be invested based on mathematical expectations. Furthermore, there is a fundamental human misconception of the time value of money. We are wired to value a dollar today far more than a dollar promised a year from now. This is why we are willing to pay a premium now for a service to be delivered later. The insurance contract is the ultimate expression of this. A policyholder pays cash now to protect against a potential loss that may occur far in the anemic future, or never at all. The insurer, by contrast, operates on a different timescale. They collect millions of nows from their customers and consolidate them into a massive pool of capital that can be invested for the long term. They are systematically arbitraging the difference between the individual's short-term psychological needs and the long-term mathematical reality of investing. They are trading on the public's desire for immediate certainty, and the compensation for that trade is the float. How can a retail investor, someone without the ability to write reinsurance contracts, apply this thinking? The blueprint is the float calculator, a method for analyzing any publicly traded insurance company to determine the quality of its hidden engine. This is a crucial piece of financial education. Step 1. Open the company's annual report and go to the balance sheet. Find the liability section. You are looking for two key line items: unearned premiums and loss adjustment expense reserves. Step 2. Sum these two numbers. This is your best estimate of the company's total float. This is the amount of other people's money they are holding. Step 3. Track the growth of this float over the last 5 to 10 years. Is this number growing, shrinking, or staying flat? A company that is consistently growing its float is successfully attracting more business and holding more capital. This is a positive sign. Step 4, and this is the most important step. Go to the income statement or the statistical supplement and find the company's combined ratio for each of the last 10 years. Is this number consistently below 100, or is it erratic, jumping from 95 to 115 and back again, or is it always above 100? A consistent record of combined ratios under 100 is the signature of a disciplined, profitable underwriting culture. This is the mark of a great insurance operation. Step 5. Combine your findings. If you find a company that is steadily growing its float over time, and time has a long-term track record of maintaining a combined ratio below 100, you have likely found a superior business. You have found a company that is not just holding other people's money, but is being paid to do so, and is gathering more of this free money every year. This simple 5-step process cuts through the noise and allows you to analyze the core economic engine of an insurer, a vital skill for any serious long-term investing strategy. The antithesis to this disciplined approach, the path of the 99% in the insurance world, is the suicidal chase for market share. This is the path that has destroyed countless insurance companies. In the industry, there are periods known as soft markets and hard markets. In a hard market, risks are high, capital is scarce, and so premiums are high. It's easy to be profitable. But in a soft market, there's too much capital chasing too few risks. Competitors start slashing prices to win business and maintain their premium volume. The temptation to follow the herd is immense. An CEO who presides over a shrinking company, even a more profitable one, will face immense pressure from Wall Street. So they give in. they start writing policies at unprofitable rates, just to keep the premium dollars flowing in the door. They tell themselves, "We may lose a little on the underwriting, but we'll make it up on our investment income." This is a fatal mistake. They are generating float, yes, but it is toxic float. If their combined ratio is 108, they are effectively borrowing money at an 8% interest rate. Their investment portfolio must then clear this 8% hurdle just to break even. They have turned the greatest asset of an insurance business, free capital, into a high-cost liability. This growth at all costs mentality is a value-destroying machine. It's a race to the bottom, and it's why the insurance industry is littered with the corpses of companies that grew fast and then died spectacularly when their underpriced risks all came due at once. The direct financial connection here is stark and undeniable. Let's quantify the difference between good float and bad float. Imagine two insurance companies, Company A, the disciplinarian, and Company B, the growth chaser. Both companies managed to generate $1 billion in float for the year. Company A, run with Berkshire-like discipline, achieves a combined ratio of 97. On their $1 billion of premiums, they pay out $970 million in claims and expenses. This results in a $30 million underwriting profit. They were times $30 million for the privilege of holding that $1 billion of float. Now they can invest that $1 billion in stocks and bonds. Let's say they earn a conservative 7% return, which is $70 million. Their total profit for the year is the $30 million from underwriting, plus the $70 million from investments, for a total of $100 million. Now look at Company B. They chased growth, writing policies at any price. Their combined ratio is 106. On their $1 billion of premiums, they paid out $1,060 million. They suffered a $60 million underwriting loss. This is the cost of their float. They too invest their $1 billion of float and earn a 7% return, or $70 million. Their total profit is the $70 million from investments minus the $60 million from their underwriting loss, for a total of just $10 million. Both companies held the same amount of float. Both were equally skilled at investing it, but Company A made 10 times more profit. The discipline of underwriting, the obsession with keeping the combined ratio under 100, is not a minor detail. It is the entire game. It is the difference between a financial rocket ship and a leaking boat. Once you have discovered the engine of float and mastered its economics, the next question becomes, what do you do with the fuel? A mountain of free cash is useless if you don't know how to deploy it effectively. This brings us to our third and perhaps most crucial pillar, the investment engine, a capital allocation masterclass. This is where Warren Buffett truly separated himself from every other insurance executive on the planet. He understood that the purpose of generating float was not merely to back insurance liabilities, but to serve as a perpetual, ever-growing pool of capital that could be deployed into any asset, any industry that offered the highest long-term return. The insurance business was the furnace, and the float was the molten steel, ready to be poured and molded into any shape he desired. He transformed a traditionally conservative business model into the ultimate opportunistic investment vehicle. This was the masterstroke, connecting a source of permanent, low-cost capital with a rational, flexible, and brilliant capital allocator. The foundational anecdote for this pillar is the acquisition of See's Candies in 1972. On the surface, this transaction makes no sense. Why would a property and casualty insurance company from Omaha buy a chain of boxed chocolate shops on the West Coast? The two businesses have absolutely nothing in common. But to Buffett and his partner Charlie Munger, the logic was ironclad. They had the float, National Indemnity, and their other insurance operations were gushing cash. They had more capital than they could intelligently deploy in the stock market at the time. They needed to buy whole businesses. They approached the See family, and after some negotiation, Berkshire Hathaway purchased See's Candies for $25 million. That $25 million came directly from the pool of capital generated by their insurance operations. It was policyholder money, the float, being used to buy a candy company. Now why See's? Because See's was a phenomenal business. It had a powerful brand, pricing power, and, most importantly, it required very little capital to operate. It was, in its own small way, a float-generating business itself. Customers would pour into the stores between Thanksgiving and Christmas, paying cash for their boxes of chocolates. See's would collect a huge amount of cash up front, but it wouldn't have to pay its suppliers for sugar and chocolate until weeks or months later. This influx of cash, this mini-float, further added to Berkshire's coffers. But the real genius was what happened after decided the acquisition. A normal company would have taken the profits from See's Candies and reinvested them back into the candy business, opening more stores, expanding the product line. Buffett and Munger did some of that, but they recognized that the returns on new capital invested in the candy business were good, but not spectacular. The real value of See's was that it produced about $2 million a year in profit, after tax, and required almost no additional capital to do so. It was a gusher of cash. That $2 million in profit was not kept inside See's. It was sent back to headquarters in Omaha. There, it was combined with the ever-growing float from the insurance businesses. This commingled pool of capital was then used to make the next acquisition and the next. The profits from See's Candies helped buy the Buffalo Evening News. The profits from the candy company and the newspaper, combined with the insurance float, helped buy pieces of Coca-Cola, the Washington Post, and eventually entire railroads and utility companies. This was the system. Use the insurance operations to generate massive amounts of low-cost capital. Use that capital to buy wonderful, cash-gushing businesses that require little capital themselves, and then take the profits from those businesses and add them back to the central pool of capital to be redeployed all over again. It was a magnificent, self-reinforcing flywheel of wealth creation. The psychological principle that Buffett and Munger exploited here is the powerful and usually destructive bias of compartmentalization, which we touched on earlier. Most corporate executives suffer from a severe case of institutional imperative. The CEO of a steel company thinks his job is to make more steel. The CEO of a retail company thinks his job is to open more stores. They feel an overwhelming psychological and institutional pressure to reinvest profits back into the business they already know, even if the returns on that new investment are mediocre. To suggest taking the profits from the steel mill and using them to buy a local television station would be seen as heresy. It's not what they do. Buffett and Munger had no such mental blocks. They did not see Berkshire Hathaway as an insurance company or a candy company. They saw it as a system for allocating capital. Their job was not to run any specific business, but to take the cash generated by all their businesses and move it to where it had the highest and best use. Their allegiance was not to any single industry, but to the principle of maximizing the long-term per-share value of Berkshire. This sounds simple, but it is psychologically revolutionary. It requires a complete detachment from the day-to-day operations and a purely rational, owner-oriented mindset. They shattered the mental walls that exist between different industries and treated all capital as a single, fungible resource. This is why Berkshire looks so strange to the outside world, a collection of insurers, railways, utilities, jewelers, and airplane parts manufacturers. It's not a conglomerate in the traditional sense. It's the physical manifestation of a rational capital allocation process, funded by the engine of insurance float. So how can we apply this? The mental model for us is the fungible capital strategy. This is a blueprint for thinking about your own career, your own business, and your own investments. Step 1. Identify your most reliable and powerful source of cash flow. For most people, this is their salary from their primary job. For a business owner, it's the profits from their main company. This is your personal float. It's the surplus capital you generate. Step 2. Emotionally detach from the source of that capital. This is the hardest part. Just because you earned the money as a lawyer, does not mean the best use of that money is to invest in law-related things. Just because your plumbing business generated a profit does not mean the best use of that profit is to buy another plumbing truck. You must fight the urge to automatically reinvest in what is familiar. Step 3. Create a universal opportunity list. This list should include every possible use for your capital, regardless of category. It might include buying S&P 500 index funds, buying a rental property in your town, investing in a friend's startup, going back to school to get a new skill, or buying a new piece of equipment for your existing business. Every potential use for a dollar goes on this list. Step 4. Evaluate every item on the list with a single, ruthless metric. What is the most likely, long-term, after-tax return on this unit of capital? You must compare the expected return from buying a stock directly against the expected return from upgrading your business's software or paying down your mortgage. Step 5. Allocate your capital to the top item on the list. You deploy your personal float to the absolute best opportunity available to you at that moment, not just the most convenient or familiar one. This disciplined, cross-disciplinary approach to personal capital allocation is a direct miniaturization of the Berkshire Hathaway model. It forces you to think like a true CEO of your own life, moving your resources to where they can work hardest for you. The antithesis, the path of the 99% for insurance companies, is the trap of timid and unimaginative asset management. The vast majority of insurance companies in the world generate their float and then proceed to do the most boring thing imaginable with it. They invested almost exclusively in a portfolio of high-grade corporate and government bonds. Why? For a few reasons. First, regulation often encourages this conservative approach. Second, it's the safe thing to do. Their job, as they see it, is to be absolutely certain they can pay claims, and bonds offer that certainty. Third, and most importantly, they lack the skill and the mandate to do anything else. An insurance CEO is an expert in underwriting and risk management, not in evaluating the long-term competitive dynamics of a candy company versus a newspaper. They stay in their lane. They see their investment portfolio not as an engine for wealth creation, but as a dull, safe vault where they store the policyholders' money until it's needed. This timidity creates a massive opportunity for a company like Berkshire. While the rest of the industry is earning 3 or 4% on their float by holding bonds, Berkshire is earning multiples of that by owning some of the greatest businesses in the world. The 99% play a game of low risk, low return. Buffett used the same raw material, the float, to play a game of calculated, intelligent risk for phenomenally high returns. The failure of the 99% is not a failure of ethics or intelligence. It's a failure of imagination and a psychological inability to break free from the conventional definition of their own business. Let's trace the direct financial connection to see how this multiplies wealth. Start with that $25 million purchase of See's Candies in 1972, funded by insurance float. By the early 2000s, See's had generated over $1 billion in cumulative pre-tax earnings for Berkshire, and it was still gushing cash every year. That $1 billion stream of profit, which required almost no capital reinvestment, was then available for Buffett to invest elsewhere. Compare this to a competitor, Conventional Insurer, Inc. They also had $25 million of float to invest in 1972. They put it into a portfolio of long-term government bonds yielding, say, 6%. Over the next 30 years, that $25 million would have grown, with interest reinvested, to about $145 million. That's a good return. But Berkshire's investment, by buying an actual operating business, generated over $1 billion. The difference is nearly an order of magnitude. And this happened over and over again. The float was used to buy businesses. The businesses produced profits. The profits were added back to the float. The larger pool of capital was then used to buy even bigger businesses. It is a financial feedback loop of epic proportions. The direct connection is seeing that the premium you paid for your Geico car insurance could have been part of the capital used to buy a significant stake in Apple. The money is completely connected. It flows from the policyholder, through the insurance operation, into the hands of the capital allocator, and out into the most productive corners of the American economy. This is the investment engine in action, a system for converting insurance liabilities into permanent, productive, and immensely valuable equity ownership. Of course, this entire system, this magnificent engine, rests on one fragile assumption, that the float being generated is good, high-quality, profitable float. If the fuel for your engine is dirty, it will eventually seize and explode. This leads us to the fourth pillar, the bedrock of the entire operation, the moat of discipline, underwriting excellence. Not all float is created equal. As we discussed, float generated at a combined ratio of 105 is not an asset. It's a high-cost liability. Float generated at a combined ratio of 95 is not just an asset. It's a miracle. The ability to consistently price risk in a way that generates an underwriting profit is the single greatest competitive advantage an insurance company can have. It is also the rarest. It requires a culture of discipline, a willingness to shrink when competitors are growing recklessly, and the courage to say no to bad business, even when it's tempting. This discipline is the moat that protects the entire Berkshire castle. The quintessential story of underwriting discipline is the story of Geico. In the mid-1970s, Geico, then a publicly traded company that Buffett had been a fan of since his youth, was on the verge of complete collapse. The company had abandoned its long-held discipline of insuring only preferred risk drivers, like government employees. In a mad dash for growth, they began writing policies for almost anyone, at prices that were far too low for the risks they were taking on. Their underwriting standards crumbled. Their loss reserves turned out to be woefully inadequate. Their combined ratio soared to catastrophic levels, well over 120. They were losing hundreds of millions of dollars, and the company was weeks away from insolvency. Wall Street had left it for dead. It was during this crisis that Buffett made one of his most famous investments. He saw that the core idea of Geico, a low-cost direct seller of insurance, was still a brilliant business model. The problem wasn't the model, it was the catastrophic failure of management and their abandonment of underwriting discipline. He started buying a huge chunk of the company's stock at bargain basement prices, betting on a turnaround. That turnaround was led by a new CEO, Jack Byrne, a brilliant and tough-as-nails insurance executive. Byrne's mandate was simple: save the company. And he knew there was only one way to do it. He didn't focus on fancy investment strategies or clever accounting. He focused on the core of the business, underwriting. He embarked on a brutal but necessary campaign. He fired a huge portion of the workforce. He closed offices. He non-renewed millions of unprofitable policies. And, most importantly, he raised prices dramatically. The company shrank massively. Premium volume plummeted. In the short term, it looked like he was destroying the business. But what he was actually doing was purging the poison. He was getting rid of all the bad business they had written in the chase for growth and reestablishing a culture where the only business worth writing was profitable business. Within a few years, Geico was not just solvent, it was phenomenally profitable. Its combined ratio fell from the stratosphere back down to the low 90s. Buffett's investment paid off spectacularly, and Berkshire would eventually go on to buy the entire company. The Geico crisis and its subsequent resurrection is the ultimate parable of underwriting discipline. It teaches that in insurance, size is not the goal. Profitability is the only goal. The psychological principle at the heart of this discipline is the ability to resist herd behavior and the powerful grip of the fear of missing out, or FOMO. Imagine you are the CEO of an insurance company. For 3 years in a row, the market is soft. Your competitors are cutting prices by 10% each year to gain market share. You are holding your prices firm because you know that at those lower rates, you cannot make a profit. As a result, your premium volume is down 5%, then 10%, then 15%. Your rivals are issuing press releases boasting about their growth. Wall Street analysts are downgrading your stock because you are losing market share. Your own salespeople are screaming that they can't compete. The psychological pressure to cave in, to cut prices just to keep up, is almost unbearable. It requires an iron will and a deep ingrained culture to stand firm and say no. We would rather shrink and be profitable than grow and be unprofitable. This is a battle against the most basic of human instincts. We are social creatures. We are wired to follow the crowd. When the herd is running in one direction, standing still feels dangerous and wrong. Buffett and the managers he hires, like Ajit Jain and the leaders at Geico, have a rare psychological fortitude. They are capable of ignoring the siren song of social proof and focusing only on the long-term economic reality. They are playing their own game with their own rules, and they refuse to be drawn into the value-destroying game that the rest of the herd is playing. How can we apply this principle of disciplined refusal to our own lives? The mental model is the no portfolio. This isn't a portfolio of things you own. It's a portfolio of things you have deliberately chosen not to own. It's an exercise in cultivating the power of avoidance. Step 1. Clearly define your underwriting standards. For an investor, this means writing down your specific, non-negotiable investment criteria. For example, I will only invest in businesses I can understand. I will not invest in companies with high levels of debt. I will not pay more than 20 times earnings for a business. For an entrepreneur, it might be, we will not take on a client who doesn't fit our ideal profile. Or, we will not enter a market where we cannot be the number 1 or number 2 player. These rules must be written down in concrete. Step 2. When an opportunity arises that violates one of your core rules, you must say no, quickly and decisively. It doesn't matter if your neighbor is getting rich on a hot cryptocurrency you don't understand. It doesn't matter if a potential client is offering a lot of money for a project that will be a nightmare to manage. If it violates the rules, the answer is no. Step 3. This is the crucial part that reinforces the behavior. Keep a journal of the bad business you turned away. Write down the stock you didn't buy, the client you didn't take. A year later, review your no portfolio. More often than not, you will find that your discipline saved you from immense pain. The hot stock will have crashed. The nightmare client would have consumed all your time. This practice of tracking the bullets you've dodged actively strengthens your psychological ability to say no, transforming it from a painful act of sacrifice into a satisfying act of prudence. The antithesis of this disciplined approach is the story of AIG before the 2008 financial crisis. This is the ultimate cautionary tale of what happens when underwriting discipline is completely abandoned in the pursuit of growth and illusory profits. AIG had a division in London called AIG Financial Products. This group discovered what they thought was a magic money machine. Using AIG's pristine AAA credit rating, they began to insure complex mortgage-backed securities by writing something called credit default swaps. In essence, they were selling insurance against the risk of these mortgage bonds defaulting. For years, this was incredibly profitable. They collected billions of dollars in premiums, generating a massive amount of float, and since the housing market was booming, they rarely had to pay out any claims. The division's profits soared, and its executives were paid hundreds of millions of dollars. They were celebrated as geniuses, but they were committing the cardinal sin of underwriting. They were taking on an immense correlated risk that they did not remotely understand, for a premium that was pitifully small compared to the potential loss. They were picking up pennies in front of a steamroller. They followed the herd, insuring trillions of dollars of subprime mortgage debt because everyone else was doing it, and the short-term profits were intoxicating. When the housing market inevitably turned, their float was revealed to be a poison pill. The claims came pouring in, not as a trickle but as a tidal wave that threatened to bankrupt the entire company and take the global financial system down with it. AIG is the poster child for undisciplined, reckless underwriting. They generated the biggest pool of toxic float in history, a mistake that ultimately required a $180 billion government bailout to contain. Let's look at the direct financial connection of discipline versus indiscipline. Let's return to the Geico example. In the depths of its crisis in 1976, Its combined ratio was a horrifying 118.1. For every dollar of premium it took in, it paid out over $1.18. On its premium volume of roughly $600 million at the time, this translated to an underwriting loss of over $100 million, a staggering sum that was rapidly depleting its capital. Fast forward to 1979, after Jack Byrne's brutal but necessary reforms. The combined ratio had plummeted to 90.5. On a similar premium volume, this represented an underwriting profit of nearly $60 million. That is a $160 million swing in profitability on the exact same business, achieved purely through the restoration of underwriting discipline. This is before a single dollar of investment income from the float is even considered. This shows, in the starkest possible terms, that the numbers generated by the core insurance operation are not a trivial matter to be overcome by investment gains. They are the foundation of everything. A solid foundation of underwriting profit, ASUB 100 combined ratio, makes the entire structure stable and strong. A crumbling foundation of underwriting losses makes the entire structure vulnerable to collapse, no matter how clever the investment strategy on top may be. Discipline isn't just a virtue, it's a financial necessity. We have now assembled the pieces. We've seen how Buffett discovered the engine afloat, understood its economics, used it to power a brilliant investment machine, and protected it with a moat of underwriting discipline. This brings us to our fifth and final pillar, where we bring all this knowledge home to you, the investor, the investor's edge, valuing the invisible engine. The single greatest costly market mistake an investor can make is to value an insurance company like a normal business. Using standard metrics like the price-to-earnings ratio or the price-to-book ratio on an insurer is like using a yardstick to measure temperature. It's the wrong tool for the job, and it will give you dangerously misleading information. By learning to analyze an insurance company the way Buffett does, you can gain a significant analytical edge over the 99% of investors who either ignore the sector entirely or misvalue it completely. You will learn to see and value the hidden engine that they miss. To illustrate this point, let's use an anecdote from Buffett's earlier career that, while not about an insurance company, perfectly demonstrates his ability to value an intangible asset that the market was panicking over. This was the salad oil scandal of 1963. A company called Allied Crude Vegetable Oil had perpetrated a massive fraud, using fake barrels of salad oil as collateral for huge loans from various banks. One of their biggest victims was American Express, which had a warehousing division that had certified the existence of the oil. When the fraud was discovered, Allied Crude went bankrupt, and American Express's stock was obliterated. The market panicked. Wall Street assumed that Amex would be on the hook for all the fraudulent loans, and that the scandal would permanently tarnish its brand. The stock price was cut in half. Everyone was selling. Buffett, however, did something different. He went out and did the legwork. He visited restaurants and travel agencies. He talked to merchants and customers. He wanted to know if the scandal had actually changed people's behavior. Were they still using American Express travelers' checks and credit cards? The answer he found was a resounding no. The fundamental business, the powerful consumer brand and payment system, was completely unharmed. He realized that American Express had its own form of float, the massive pool of cash from travelers' checks that had been sold but not yet cashed. He understood the value of this float and, more importantly, the incredible power of the intangible brand in the minds of consumers. While the rest of the market saw only a massive, terrifying liability from the scandal, Buffett saw a temporary problem obscuring a wonderful, still intact business franchise available at a ridiculously cheap price. He invested 40% of his partnership's capital into American Express and made a fortune. This is the mindset you need to bring to insurance. You must be able to look past the scary, complicated liabilities and the noisy short-term events to properly value the long-term, durable engine of the business. The psychological principles that cause the market to make these mistakes are powerful and pervasive. The first is salience bias. Our brains are wired to pay disproportionate attention to things that are vivid, recent, and emotionally charged. A massive hurricane, a major earthquake, or a financial scandal are all highly salient events. When an insurer reports a huge loss from a catastrophe, investors panic and sell the stock, fixating on the short-term loss while ignoring the fact that the company may have just raised its prices significantly, improving its long-term profitability. They overreact to the visible damage and ignore the invisible improvements to the underlying business. The second bias is the affect heuristic. This is a mental shortcut where we make judgments based on our emotions. For most people, the feeling associated with insurance is boring, complicated, and I don't understand it. This negative feeling leads them to simply avoid the entire sector. They don't put in the work to understand it because their gut tells them it's not worth the effort. An investor who can overcome these biases, who can remain calm when others are panicking about a salient event, and who can approach a boring industry with intellectual curiosity, gains a massive and sustainable edge. They can be rational when the rest of the world is being emotional. This brings us to our final blueprint, the two-engine valuation method. This is a practical, step-by-step guide for any investor to approximate the intrinsic value of an insurance company. You must value it as two distinct businesses, the insurance operation itself and the investment portfolio. Step 1. Value engine number 1, the insurance operation. The key here is to assess the quality of the float. Look at the company's 10-year track record of combined ratios. If the company has a consistent history of profitable underwriting, an average combined ratio well under 100, its insurance business is a gem. It is creating value. In this case, the business is worth a significant premium to its book value. A good rule of thumb might be to value it at 1.5 to 2 times book value. If, however, the company has a history of breaking even, a combined ratio around 100, it's a mediocre business, probably worth about its book value. If it has a history of underwriting losses, a combined ratio consistently over 100, the insurance operation is actively destroying value, and it's likely worth less than its book value. Step 2. Value engine number 2, the investment portfolio. You must look at what the company owns with its float and its capital. Go to the annual report and find the breakdown of their investment portfolio. Is it almost entirely low-yielding government and corporate bonds? Or is it, like Berkshire, filled with large holdings of common stocks in great companies and even wholly owned subsidiaries? You must value this portfolio at its fair market value. For a bond portfolio, this is relatively straightforward. For a stock portfolio, you can simply look up the market value of their holdings. Step 3. Combine and compare. Add the value you calculated for the insurance operation, Engine 1, to the market value of the investment portfolio, Engine 2. This gives you a rough estimate of the company's intrinsic value. Now compare that number to the company's current stock market capitalization. If your intrinsic value estimate is significantly higher than the market cap, you may have found an undervalued opportunity. This two-engine approach prevents the cardinal sin of using a single metric like price to book, which completely fails to differentiate between a high-quality insurer and a value-destroying one. The antithesis, the path of the 99%, is to rely on these overly simplistic one-size-fits-all valuation metrics. The average retail investor and even many professional analysts will look at an insurance company and see a price-to-book ratio of 0.8. They think, great, I can buy $1 worth of assets for 80 cents, it's a bargain. But they have done none of the real work. They haven't checked the 10-year record of combined ratios. That company might have a price-to-book of 0.8 because its average combined ratio is 110. Its core business is a raging dumpster fire, destroying 10 cents of value for every dollar of premium it writes. Buying it at 80 cents on the dollar isn't a bargain. It's catching a falling knife. Conversely, they might see another insurer trading at a price-to-book of 1.7 and think, that's too expensive. But they fail to see that this company has a 20-year record of combined ratios in the low 90s and an investment portfolio filled with wonderful businesses. Its float is not only free, but profitable, and it is being invested brilliantly. A business of this quality is likely a bargain even at 1.7 times book value. The 99% are using a blurry, out-of-focus lens to look at the industry. They see only the surface-level accounting numbers and miss the deep economic reality. By using the two-engine method, you are putting on a pair of high-resolution glasses. You can suddenly see the quality of the engine, not just the size of the chassis. Let's make this concrete with a final direct financial connection. Imagine Good Insurer Inc. and Bad Insurer Inc. Both have a stated book value of $10 billion. And both, for the sake of argument, are trading on the stock market for a market cap of $10 billion, a price-to-book ratio of exactly 1.0. The average investor would say they are fairly valued and look identical. But now we apply our two-engine analysis. Good Insurer has a 10-year average combined ratio of 96. Its underwriting is consistently profitable. Therefore, we value its insurance operation at a premium, say 1.5 times its book value, which is $15 billion. Let's assume its investment portfolio is also worth $10 billion. Its total intrinsic value is $25 billion, but it's trading for $10 billion. It is deeply, profoundly undervalued. Now let's look at Bad Insurer. It has a 10-year average combined ratio of 107. Its core business is a value-destroying machine. We would value its insurance operation at a discount to book value, perhaps 0.7 times, which is $7 billion. Its investment portfolio is also worth $10 billion. Its total intrinsic value is $17 billion. But wait, that seems high. A company that consistently destroys shareholder capital in its core operation should not get credit for its full investment portfolio. A more realistic valuation might apply a significant discount, recognizing the high probability of management continuing to make poor decisions. Let's say the true value is closer to $8 billion. This company, also trading at $10 billion, is actually significantly overvalued. To the 99% of investors using a simple price-to-book ratio, these companies looked identical. To you, armed with the proper mental model, one is a screaming buy and the other is a dangerous trap. This is the investor's edge. It is the ability to see the invisible engine afloat, to assess its quality through the combined ratio, and to value the entire enterprise as the sum of its two powerful parts. You have just invested a significant amount of your time and attention, and in doing so you have acquired a powerful mental model that demystifies one of the most potent wealth creation engines on the planet. You now possess the framework to look at what seems like a boring, complicated industry and see it for what it truly is at its best: a dual-engine machine of disciplined underwriting and intelligent investment, powered by the incredible, almost magical concept of float. You no longer see just a name on a stock ticker. You see the flow of capital, the quality of the decision-making, and the hidden value that the majority of the market completely overlooks. This knowledge separates you from the crowd. But understanding this engine, as critical as it is only the first part of the equation. The float is the fuel, the vast ocean of capital. But an ocean of fuel is useless without a skilled navigator and a powerful ship to carry it. How Warren Buffett takes the capital generated by this insurance engine and makes the decisions on where to deploy it. How he decides between buying a railroad, a utility company, or a massive stake in Apple is a completely different yet interconnected layer of his genius. Mastering the source of the capital is step one. Mastering the allocation of that capital is the next frontier. It is the bridge between the insurance operations and the vast, eclectic empire that is the rest of Berkshire Hathaway. The video that is now appearing on your screen is designed to be that bridge. It is the next piece of the map. Today, we have mastered the how of the money machine, how the capital is generated. That next video explores the what and the why, the specific mental models and valuation techniques Buffett uses to decide where that river of cash should flow. It connects the engine room of the insurance business to the bridge, where the crucial executive decisions are made. It is the link that completes the circuit, showing how the premium you pay for car insurance is rationally and systematically transformed into ownership of the world's greatest businesses. Most people will stop here, satisfied with understanding this one powerful concept, and that is fine. But for those of you who are on a genuine journey to achieve financial mastery, for those who seek to build a complete mental arsenal of effective models, the journey doesn't end. True understanding isn't about collecting isolated facts, it's about building a latticework of interconnected concepts. The choice to continue is the choice to move from being a passenger to becoming the architect of your own financial future. Click and continue your ascent.